In topic 5, we looked at the use of calculations involving what's called the time value of money. Just wanted to take a quick uh, little review of how we're going to be applying this in accounting. And these techniques come into play in what are called fair value measurement. Fair value measurement is listed as a topic in the FASB codification, and it is under the broad transactions category, and it is topic 820, fair value measurement. And let's just look at some of the terms that are used in this topic area and get a general idea of what fair value measurement is. If you remember back to topic 2, we discussed what fair value meant, and the definition given in the code is this. Fair value is a price that would be received to sell an asset or transfer a liability in market conditions. And the measurement date is the date on which we are determining this fair value, which is typically a balance sheet amount. So we're usually talking the balance sheet date equals the measurement date. There will be an initial measurement when we take on an asset or are valuing a liability, and then there would be subsequent measurements at each balance sheet date. In topic 820, GAAP lays out a hierarchy, and they put 3 levels at this hierarchy. The first and most desirable is where we have an active market. And an active market is defined as a market in which transactions for the asset or liability take place with a great amount of frequency and volume that allows us to have a set market value. And the best example of this would be for stocks and bonds traded on the New York Stock Exchange, for commodities traded on the Chicago Board of Trade. The other valuation that would meet a level 1 is when we talk about replacement costs. If we have an asset, say a plant, well, the fair value of that plant would be equal to what it would cost to buy or secure or build another plant of equal quality. So we can either talk about a market or we can talk about replacement costs. The second level deals when we have a situation where there is no exact market for the asset or liability that we're looking at, but there are similar assets and or liabilities that are traded in an open market. And this would, an example of this would be if we have a private company, one that is not publicly owned, and we have debt instruments. Well, if we were to match up our debt instruments with those of a publicly traded company, well, of the same risk level that we are, we could approximate the fair value of our liabilities or assets. Finally, the last and least desirable involve techniques that use the time value of money. In future courses, we'll be looking at weighted averages of potential future cash flows. We will then use the present value technique that will take these weighted averages and determine the present value of an asset or a liability. Another technique involves the analysis of cash flows, where we'll take a string of cash flows, use a discount rate, and determine its current present value. So present value calculations are used at the measurement date to determine the present value of some future amount. And these can either be numbers that we have a good estimate based on contracts, or they can be a weighted average based on statistical probability. And we'll be looking at these types of fair value measurements in future courses. And this has just been a bit of a preview of the use of fair value. Again, it's important to understand that fair value does not always mean a market price, nor does it always mean a discounted cash flow analysis.